Welcome back to the TTN Mentorship. In this one, we're going to be breaking down Candlesticks 101, the open, high, low, and close of each candlestick. This is going to be the foundation of everything that follows: market structure, liquidity, setups. We have to master this first because this is the most important and crucial step in trading, especially because we trade candlestick charts. We need to know that every single candlestick, no matter what time frame you're on, has 4 key data points. That is going to be the open, where price started at a specific time, the high, the highest price that it traded throughout that period of time, the low, the lowest price traded throughout that period of time, and then the close, where price ended in that increment of time. It's super simple. That's it. And it tells the whole story. Now, how do you delineate if one is bearish or if one is bullish? We are going to be able to tell if the close, an example of a bullish, is higher than the open. So if price closes higher than it opens, then we know that that is a bullish candle. And that means that price is moving up. And that means that buyers were in control in this increment of time. And then for a bearish example, we know that if price closes below the open, then it was bearish and price is moving lower in that specific increment of time. So when you're on your chart, you will see an increment somewhere, whether it's a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, so on and so forth, all the way up to daily, weekly, monthly. That is the increment of time that the chart is measuring in what you're looking at. Now we're going to talk a little bit about specific candle types, and we're going to be talking more so about directional candles on higher time frames. This is going to be a candle that moves in one direction very strongly. So it's displacing one direction very strongly. So think expansion, where you have an open, a low, and then a high and a close. So an open, low, high, close. Or bearish, it would be an open, high, low, close. These are going to be the directional candles on the high time frame. And when I'm referring to high time frame, I'm more so talking about 15-minute or above. So an example of a bullish high time frame directional candles would be this. We have price opens at a specific point, and then from this higher time frame increment, so say the course of 1 hour, it makes a low, it puts in a low, and then continues to trade higher after putting in a high up here, not a low. This would be the high, and then closing lower than that high. This would be a bullish directional candle. Then we know the opposite would be true for a bearish directional candle. So you would have the open, a high is put in here, a low, and then price would close slightly higher, giving us a strong directional candle. As you can see, over this increment of time, price is moving almost very strongly in one direction. The next thing that we're going to be talking about is reversal candles. These can indicate that price was moving lower in the sense of a bullish, and then reversed and started trading higher on a high time frame. So you're going to have an open, a low with a long lower shadow or lower wick relative to the body of the candle. You're going to notice that price closes almost near the high. The opposite, again, would be true in a bearish example. You're going to have a high, and then you're going to notice that relative, again, to the body, this upper shadow is larger than the body. So price was trending higher at this point and then reversed and almost closed all the way at the low. Next, we'll be looking at dojis. This is a special candlestick. This typically represents indecision in the marketplace because the candle can't close in one direction very strongly or show that it reversed. So relative to the reversal bullish candle, you notice that price left a large lower wick and then decided to close higher. This, you can see that the close and open are almost relative equal on both a bullish doji and both a bearish doji. And you can also notice that the wicks are relatively similar. This means that price couldn't decide where it was going to go. This can happen in consolidation periods where price is just moving sideways. But it's a good thing to notice because this really just shows indecision in the marketplace. The next special candlestick that we're going to identify is a devil's mark. Devil's mark are super simple. As you know, candlesticks have four things: open, low, close, and high. When you see a devil's mark, it simply means that price didn't leave or didn't print a wick on one side of the body. So in a bullish example would be it didn't print a low. The low is the open. All this means is that price strongly displaced from the open and closed significantly higher. Again, strongly because it doesn't put in a low. So price never traded below the open. And then the same again would be true for a bearish example. In the case of a bearish example of a devil's mark, you're going to have an open and a high are relatively, if not the same exact price, where it then trades and displaces lower strongly. Just start to familiarize yourself with candlesticks, what it means, understanding how price is moving relative to those candlesticks. Because in the next episode, we will be diving actually into the charts and looking at things on a market landscape.